Hello and welcome to this video lecture. In this lesson, we'll explore the basics of universal life insurance. We'll walk you through some real-world scenarios where key technical terms like contract account values, surrender values, and benefit reserves come into play. You'll see exactly how and when these concepts work in action and how they impact the policyholder's cash flow and overall policy management. Through these conceptualizations and scenario-based discussions, our goal is for you to learn how to design basic life insurance, project contract account and surrender values, determine the various secondary contract guarantees, and to model the cash flows of these policies. This lesson will introduce you to the unbundled, flexible nature of universal life insurance, an approach quite different from the traditional insurance policies covered in previous lessons. In traditional insurance, the premiums and benefits are fixed, but in universal life insurance, the policyholder can adjust both the premium amount and timing within set guidelines, giving them more flexibility. So, let's dive in and explore how this flexible insurance policy works.
Unlike the traditional insurance with fixed premiums, universal life insurance allows policyholders to adjust their payments and benefits over time. However, it is important to maintain a sufficient account value to keep the policy active. A universal life policy offers flexible premium payments. The policyholder chooses how much to pay as long as there is enough in the account to cover expenses and insurance costs. The death benefit is also adjustable, which makes it more dynamic than the whole life insurance. The account value of a universal life insurance policy changes over time based on the premiums, expenses, insurance costs, and interest. If the policy remains active at time t, the account value is equal to the previous account value at time t minus 1 plus the premium p sub t minus the expense charge EC sub t and the cost of insurance COI sub t, all multiplied by 1 plus I sub t raised to c, where I sub t raised to c is the credited interest rate. In simple terms, the previous account value increases with premium payments, expense charges and insurance costs are deducted, and the remaining amount accrues interest at the credited rate I sub t raised to c. But note that in a basic universal life policy, funds are pooled into the insurer's account. Also, the policyholder sets the premium, the insurer determines the expense charges, and the account's growth depends on the frequency of the payment.
Now, at the start of each new period, your policy can go in one of three ways. First, it can simply keep going and accumulate more value. Second, you might decide to surrender it, which means you'll receive a cash value. This cash value is just your account value minus a surrender charge. Third, if the unfortunate happens and the policyholder passes away, a death benefit is paid. For one type of policy, this benefit is a fixed amount, while for another type, it's your account value plus an extra fixed amount. A factor called the quarter factor makes sure that the benefit never falls too low. Sometimes your account value might be lower than what's needed. That's where the additional death benefit or ADB comes in. Think of ADB as extra money the insurer adds on if your account value isn't enough. For a policy with a fixed death benefit, the extra is either the difference between that fixed amount and your account value or a percentage of your account value. For the other type, it might just be a fixed extra amount. This extra bit ensures you get a solid benefit no matter what.
Now let's talk about the cost of insurance or COI. Every period, the insurer deducts COI from your account. It's basically there to cover the risk that the insurer might have to pay out more money on the death benefit if your account is low. In the simplest terms, COI is calculated by multiplying three things: the probability that death occurs during the period, a discount factor, and the extra amount needed, the ADB. This ensures that the insurer has enough funds to cover the risk. For the next slide, for a policy with a fixed death benefit, which we call Type A, the insurer calculates the COI in two ways. One calculation is used when everything is in the normal range. That is, when the policy meets the minimum requirement. The other calculation kicks in when the policy doesn't meet the requirement and the risk is a bit higher. In that case, the insurer picks the higher number to make sure there's enough money to cover the risk. It may sound technical, but just remember, they compare two methods and use the one that covers the risk best. For the next slide, for a policy where the death benefit is your account value plus a fixed extra amount called Type B, the process is similar. If your account is healthy, the COI might simply be based on that extra fixed amount. But if your account is lower, then they add a little extra in a similar way to Type A. Again, the insurer chooses the higher value to ensure they are covered. It's all about balancing the risk with the extra benefit that you're promised. Now, let's go through a quick scenario. Imagine you have a policy with a fixed death benefit of $100,000. At the end of the last year, your account was worth $50,000. At the start of this year, you pay a premium of $2,000 and some fees, like a small expense charge and the cost of insurance, are taken out. Now, if you choose to surrender the policy this year, you'd receive the account value minus a small surrender charge. But if the policyholder passes away this year, the death benefit paid will be the higher amount, between $100,000 and 2.5 times your account value. This way, the benefit is always enough. Now, consider another scenario for a different type of policy, where the death benefit is your account value plus an extra $100,000. Suppose your account starts at $20,000. You pay a premium of $1,000 and there's an expense charge of $100. With a small interest rate applied, the account value updates at the end of the year after subtracting the cost of the insurance. This shows even after fees and costs, your money can still grow over time to help maintain your benefit.
Now we'll be discussing some additional features. Let's start with the policy loan. This is usually offered by insurers, which let policyholders use their account as a collateral when they take out loan. For example, you have a universal life insurance with a cash value of 1 million. Then suddenly you had an emergency and need half a mil. But instead of taking out a high interest loan from a bank, you borrow from your insurance policy since policy loans have lower interest rates. Now, this helps you cover emergency expenses without giving up your insurance coverage. But when this loan is taken or when the policyholder decides to cancel the insurance coverage, then the surrender value payable would be equal to the cash value minus the outstanding loan balance. Other insurers offer universal life insurances with secondary guarantees. Now, this is often used to make their products more attractive, but these are just some additional benefits. So one of the most common use guarantee is the no lapse guarantee. This ensures that the policy remains active and still valid to ensure policy holders continue to be protected by the policy as long as the terms are met. Other secondary guarantees include the minimum cash value, which ensures the policyholder always have a certain amount of cash, the minimum death benefit, to ensure that the beneficiaries receive a minimum payout regardless of the market fluctuations, and last, the minimum credit interest rate, which ensures to protect the policyholders' investment over time and provides financial stability.
So now let's discuss the importance of projected account values in universal life insurance and why they play a crucial role in financial planning. So projected account values help us understand how a universal life insurance policy evolves over time. Since this type of insurance includes both a death insurance and a savings component, tracking account values allows us to see how the policy grows and how different factors influence it over time. One of the key aspects of these projections is showing how premiums, expenses, and credited interest interact. By projecting these values, both insurers and policyholders can anticipate how much will accumulate in the account and how long the policy will remain. So, additionally, projected account values help determine the total death benefit and surrender benefit. The death benefit is what the beneficiaries will receive when they pass away. And while the surrender benefit is what the policyholder can withdraw if they decide to terminate the policy early. So policyholders can modify their premium payments or withdrawals according to these projections, while insurers utilize them to assess the long-term viability of their policies.
So, profit testing may seem familiar to some of us as it has already been discussed in the previous lesson. However, in this section, it will be composed of three components as you can see from the slide, which is essential to compute for the expected profit. So for our EDB, like from the previous section, it will be divided into two contract types. So for type A, our EDB is equals to this formula. For type B, it is equals to this formula. Now please do note what each variable represents to better understand the equation. Next, for ESB, we assume that the surrenders occur at year ends only. Hence, ESB is equals to this formula. Moving on to our EAB, we consider that if the insurer holds the full account value as a reserve for the contract, then the EAB is equals to this formula. Now, using the profit testing basis, we can calculate the expected profit by using the following formula of the expected profit shown in the slide. Now, please do note the remarks shown here. So, we use the earned interest rate when we project an account values and credited interest rate when we conduct a profit testing. Same thing applies for the expense charge and the incurred expenses. Now, given the values of the expected profit for different time points, we can calculate the profit vector and the profit signature. Now, to better understand how to get the expected profit, let's try some problem to apply it.
Considering 80-year term universal life insurance on age 40, we can have the following given. So in this problem, we want to find the profit vector and the profit signature. For the profit vector, we need to find the expected profit on time 0, time 1, time 2, and time 3. So at time 0, the initial expense is 200 and the expected profit is negative 200. This means that the initial expenses are incorporated in the PAR sub 0. Then, to find the expected profit on time 1, 2, and 3, we first need to find the EDB, ESB, and the EAV. So the EAB for time 1, 2, and 3 are shown by these computations. As you can see, the only difference between the three is the values for the death probabilities, which is 1.2 times the mortality rate from the ILT starting at age 40. Then, for ESB, we have the following. In here, the values that varies are the death probabilities and the premiums. Then, for the EAV, the values that varies are the death probabilities, premiums, and the surrender rates. So, after computing for the EDB, ESB, and EAV, we can now find the expected profit for time 1, 2, and 3. The expected profit is given by the following. Then, by combining all the expected profit, the profit vector will be negative 200, 447.65, negative 309.36, and 215.67. Then, after finding the profit vector, we can now proceed to find the profit signature. From the previous lesson, the profit signature is given by this equation. So first, we need to find the TPX, or the probability that the policy is still in force at time t. So we have the following values for P sub 40 and 2P sub 40. Then multiplying these values on expected profit on time 2 and time 3, the profit signature will be negative 200, 447.65, negative 292.92, and 193.12.